well, why is everyone so obsessed with the Fed and mortgage rates? Like, is it just because people don't know better? Why is there that focus? And the answer I found is the bond investors are going to take, and how you said influence, that's the right word. The bond investors are going to take Fed action into consideration because they say if the Fed does this, what does that mean for the economy? And then bond investors are trying to forecast out what's going to happen to economic growth. And so they are influenced by Fed policy, but really they're the ones who are determining what's going to happen with the fixed rate mortgage. And what's awesome for your listeners is every day you can open up the Wall Street Journal, you can see where the 10-year treasury is, you can know what the historical gap between the two, and you can forecast out where rates are today. And so it's a really useful tool when you actually step back from Fed policy and say, oh, just look at the 10-year treasury, and you have a pretty good idea of sentiment and mortgage rates. But I think what we should notice, though, is that this graph, if you're looking at it on the online version, the blue is the 10-year treasury. And when we were talking about the fourth quarter slowdown, this is when the 10-year treasury hit 3.2, and that's when rates had gone up to right about 5%. What we've seen since then is the 10-year treasury, last I looked today, it was 2.1, and mortgage rates are 3.75. And again, we're excited about this because we've seen all of those stats on affordability and a price ceiling and what it means. But we also need to think about why would the 10-year treasury be going down? And it is going down because investors are saying, well, there is some slowing domestic growth. There is some trade tensions. We're seeing China slowing, Germany slowing, Turkey's in a recession. All of those factors say to investors, well, I'm a little bit nervous. And if I'm nervous, I want to put my money somewhere safe. The government bonds and bills are considered safe. Bond price goes up, bond yield goes down. So it's not that rates are down because everything's great. It is actually that rates are down because there's a little bit of unease. But you could also argue that it's down because, again, if you're yield hungry and you're an investor, you're not going to Germany, you're not going to Switzerland, you're not going to Japan because those are negative yielding. You're going to go to the US where at least you can get a little bit of return for your money. And then finally, just for last thing on rates is what could make them go up? Well, if you see when we started about auto sales and we started about the housing market and we talked about CapEx spending, if you start to see those numbers start to trick back up, investors will say, okay, things are starting to look better. If China's numbers come out better, if you see inflation, if we get a rate cut, there are different things that could make rates go up. But I think as an industry, we need to remember that when rates go up, it's not a bad thing. It's actually that the economy and the outlook look good, which is counterintuitive. And I know that it hurts our industry to some extent, but there also is some positive when rates go up.
Oh, sure there are, yeah. Everybody thinks, it's good when rates are down. It's good when it's a seller's market. Not necessarily. Yeah. There are benefits to the other side of that equation too, of course, yeah.
Yeah, totally agree. All right, so this is what we were talking about earlier, which is really understanding the difference between leading and lagging indicators. And this came to my attention because when I started presenting for my company, it was 4 years ago, and I was just kind of getting used to what I was going to present to our audience. It wasn't my first job, obviously, but it was the first time I had done big presentations, and I went for the low-hanging fruit. I went for things like consumer confidence because I understood that, and that made sense, and I always saw the Wall Street Journal, and Bloomberg was presenting on it. But this is consumer confidence, and you're looking at it today, and you are like, awesome. Like, this number looks so good. We're seeing this hockey stick up. We've seen this huge increase in consumer confidence. And what I want you to focus your eyes on is right here is 2007. And I'm pulling this up, and you can see consumer confidence was super high. It leveled off for a few months, and then it crashes. So if you're looking at consumer confidence, you have no idea that this is about to happen because things look great.
So what Allie's saying is in 2007, right on the eve of the Great Recession, consumer confidence was high. You didn't know that it was going to drop off. It looked good. And so this indicator, you're saying, was faulty. It's not faulty, but it's not a good, you certainly can't look at it in isolation, right?
No, exactly. And what it's good for is, so the recession started December 2007, and there's an organization called the National Bureau of National Bureau of Economic Research. I think that's it. And they're the ones who officially call a recession. And they need to look at all of these different data points to figure out when it is. What this can do is if the December 2007 was the start of the recession, December 2008 is when they officially called it. If you were looking at this data, you would know that you're in a recession. So it's good at telling you that you're in a recession before it's officially announced. It's just not good for you to pivot your business strategy ahead of time because you have no idea that there's a change coming. So that's one. Here's another one. This one is very visual to look at, but this is looking at the GDP number. You want to be at 3%. That's generally been the target. If you're looking at this graph, you see that we haven't often been hitting 3%, and that's been concerning. But it goes back to our discussion earlier. We created this index, over 50 years ago, and are we measuring it right? That's a whole nother discussion. But if you're looking at this GDP number and you're saying, okay, awesome, we're at 3%, this is great, we see that the market's moving in the right direction, I would then have you look at GDP back 2004 to 2007. And so you're looking at this graph, and if you're not looking again, it's basically showing that GDP hovered between, let's say, 1.5% and 4% from 2004 to 2007. Fourth quarter 2007 comes and GDP is 2.5%. You know that the target's 2.5%. Okay, good. You can round up. We're at 3%. This is awesome. Well, what happened in fourth quarter 2007? Well, we just talked about it. The recession started.
Yeah, the Great Recession.
The Great Recession. Yeah. So you're looking at this and you think everything's great, and then, oh my gosh, out of nowhere, it collapses the following quarter.
And you
see a little bit of
GDP.
Rebound, goes down again. Yeah. So this indicator too, it can tell you when we've gone into a recession, but does that help you? Maybe there is some value in that, but if you're actually looking for forward planning, GDP is not your number. Now, lagging. So this is the last one I want to hit on in terms of lagging, which they also call them coincidence indicators. This is non-farm payrolls. And I will be honest with you, I loved this number so much, I wrote a rap about it. I won't do it here, but just think instead of shots, change it to jobs. So I took LMFAO's rap and changed it. But I used to love this indicator because I thought this is great. This is timely. You get it the first Friday of every month. Like, this is your best gauge of what's going on in the marketplace. Well, the problem is, again, this graph now, it's a little bit confusing to explain, but once you get it, it makes sense. What it's showing you is 12 months before the recession, which if you're looking, that's the gray, and then the 12-month average 24 months before recession. And you see that it's positive. Every 12 months before the recession, it's positive. Before that, it's positive. And you don't see job growth go negative until you're in the recession. And in fact, the 12-month average right before recession is $150,000 jobs added. And so this one too, you're looking at 150,000 jobs added and you're saying, awesome, but you're not seeing that that's going to give you any warning. It does look at each of these. It does go down. It does go down. The average starts to go down before a downturn, but it's not going to go negative. And I know even people in my own company have said, well, just wait for job growth to go negative. No, don't do that because that's wrong. So instead of that, then, my team went through really any indicator that we could find that actually does have predictive power. And we looked for ones that would at least give you a 2-quarter heads up and ones that would go further out. We have one that'll give you 3 years. Now, I've gotten in debates with my friends about whether or not an indicator can give you 3 years warning of a recession, and maybe you don't agree with that, and that's fine. But there are different ones that'll give you 6-month, 12-month, 18-month warning, and it's spread across a whole bunch of different sectors. Whether it's actually the housing inventory is a good leading indicator, whether it's manufacturing, whether it's retail sales, whether it's inflation, unemployment. There's a small business survey that has a component, even the yield curve. So there are a lot of different leading indicators that in isolation don't pull up home sales and say, well, Allie said that when home sales go down, there's going to be a recession. You need to look at these in combination. But when you do that, you can, the best you could, forecast out some kind of change in the overall market. And right now, these are telling us that there's growth in the overall economy for at least the next 12 to 18 months. So we are seeing some positive signs from these stats.